Welcome back to the Mason's Arms. My name is Jo Tomlinson, and today I will be presenting the final session on raising finance and funding. In this session, we're going to have a look at lending products because there are lots of different lending products on the market, and you need to find the product or products which are right for you in the circumstances that you have at the time you're looking for funding. So what do we need to look at? The first thing that people often don't consider when they're looking for access to finance is family, friends and your own cash. Now, sometimes, you might have a family member, a parent or, someone else who will say, I'd like to invest in your business, or I am more than happy to lend you some money. Well, what we need with this route is to establish exactly what that is. Because they're family and friends, or because it's your own cash, sometimes we fail to do our own due diligence. We fail to do our own establishment of the terms of the agreement. But it is still an agreement. And the last thing we want to do is fall out with our friends or our family. So if we are going to have access to finance through family and friends, we need to establish, is it a loan or is it equity? And if it is a loan, will interest be payable? And when will it be paid back? If it's equity, what level of shares are they going to get in that? Are they going to be a silent partner? Do they want to be involved? What is the timescale over which we believe we're going to be able to pay that money back? Let's establish up front the rules of the agreement that we're making, because that will mean that we don't have misunderstandings and disputes later down the line, and we really don't want those. So if that finance is going to go in as equity and they're going to take some of your shares, then you should be having a shareholders agreement. And if it's a loan, then you should be having a loan agreement. And even if these are not done with a solicitor, at least document everything, the amount, when it's going to be paid back, any interest, timescales. Let's get it all down and documented and everybody sign it, so that everybody up front understands the rules of what you have agreed. Now, if you go down the traditional loan route, which most of us understand, these fall into different categories again. You've got secured and unsecured. Mostly unsecured loans are smaller loans. So if you're going to want a bigger loan, they're going to want some kind of security against it. But always start with the bank. The banks have got the best interest rates. If you go with your bank first, all of the information that they need, you're going to need for any of the other funding providers anyway. So why not go in first for somebody who's going to offer you the lowest cost solution? See what they're prepared to offer, and if it's not something that meets with your expectations, then you can always go out to the wider market and have a look at some of the other providers that are out there. And the range of providers is massive, as is the range of interest rates that they are going to charge. So start with the bank, have a look at that, and then use that same information to go to other providers. There have been lots of COVID-19 loans and support measures that have been available, and there is still one that is available now, and that is the recovery loan. And if you qualify for the recovery loan, then that actually is probably the best product on the market at this point in time. You can get a significant amount of money loaned through it, and the government will guarantee 80% of that loan. With no interest or fees for the first 12 months and an interest rate of only 2.5% afterwards, then this does represent really good value. So I would suggest that that would be your first point of call, and just check whether or not you do qualify for the recovery loan before you look at any other loan products. If you haven't started trading yet and you need pre-trading finance, then there are some pre-trading loan products that are out there. Generally, it's only up to £25,000, and often you'll find that they're charged at a flat rate of 6%. So that would mean that over 3 years you would end up repaying £29,520. But if you're pre-trading, your options for getting finance are much reduced. So this loan product might be the only one that you can consider if that's the situation you're in. Grants are a great source of finance. I mean, it's fantastic because with a grant you don't have to pay it back. Now, there are certain criteria that you need to fulfil to be able to get a grant, and in most cases this would be specifically purchases of plant and equipment or some building modifications, but they're certainly worth looking into. Typically you'll get a percentage of the amount that you spent back. So you have to find the money to spend on it up front, and then you will get a percentage of that back through the grant. And traditionally with grants they don't cover VAT. So if you're spending £100,000 on a piece of plant and equipment and you've got another 20 grand to find in VAT, the grant wouldn't cover the VAT element. So finding the upfront purchase and the VAT can be a bit restrictive, but grants, as I say, fantastic because you don't have to pay them back. Asset finance. So if you were buying plant and equipment or vans or any kind of saleable asset, then there is a kind of finance called asset finance that would be secured against that particular asset. And sometimes you can get better rates if you've got an asset to secure it against, because if you default on that loan, the loan company can then sell off that asset to repay the loan that you haven't paid. So if it is a loan that you're looking for against specific items of plant and machinery, plant and equipment, vans, then maybe asset finance, that might be the route for you. Invoice financing. Let's not get this confused with factoring. They are quite different animals. There are a lot of similarities, but fundamentally they're also quite different. So if you think about invoice financing, if you use invoice financing as your access to finance, you would typically get the access to the funds after you've done some work and raised an invoice. You upload it onto some kind of portal that your provider will provide for you, and then you can download, draw down any kind of payment against that into your personal bank account. You would chase those payments yourself. You would typically have a different bank account, but you can just tell your clients, your customers, that you've got a different bank account, but you're still chasing the payments. You're still in charge of that relationship. Now, the terms vary with different agreements, but typically if an invoice hasn't been paid within 90 days, then you would lose the facility for that amount of money. So you do still need to chase that money in. You would typically be charged an upload fee, and that varies between 0.85 pence in the pound and 1, so 1% of what you load. And then there'd be an interest rate, and the interest rate is on any outstanding balance that you've drawn down. And typically this is at quite a good rate. There can, though, be watchful for setup fees and also for minimum monthly charges, because you can get that too. And also be really mindful of being tied up into agreements that can be 6 months or a year long. And sometimes you might want this for a relatively short period of time and then not be able to get back out of it and be caught up with that monthly minimum fee, even though you're not using the facility. Invoice financing is fantastic if your business is growing because it grows with you. But just watch, the devil's in the detail, just watch the agreement. I did mention that there was a difference between factoring and invoice financing. And the big difference with factoring is the fact that you don't chase your own debt. Now, this has an impact on the cost of this facility because the funding provider is going to need to provide people who are going to be phoning your clients and asking them to pay the invoices. So the fee is higher. But even more importantly than this, your customers will not like the fact that the factoring company are phoning them about the unpaid invoices. They tend to get a bit upset about that, especially because the funding providers, people who are doing the debt collection, might go in with their size 14s all over your client relationship, and you don't want that. So the big difference between the two is who manages the relationship. So I think this is a great facility if we look at the invoice financing side, but really think carefully before you go into anything to do with factoring. Now, something that I just want to help people understand is the difference in terminology between an APR and a fixed rate. So we talked earlier, on an earlier slide, about those startup loans, and we talked about a fixed rate loan. Now, as long as that's declared, that's absolutely fine, and it's totally legal for somebody to declare an interest rate as being fixed rate, but that is not the same as an APR. With an APR, you're charged interest in whatever the outstanding balance is as you go through the agreement, which over 2 years is going to tail off based on the amount that you're repaying each month. So the amount of interest you pay over the term on an APR at 6% over 2 years is going to be half that it would be on a fixed. On a fixed loan of 6%, you're paying 6% on the amount you loaned for 2 years, regardless of the balance that's outstanding at any time. Again, the devil is in the detail. Do check. They do need to, by law, also quote the APR. So if you're looking at a loan and thinking, 6%, that's a good rate, and then you look a bit further and find out that the APR is actually 12 or even higher, then you might have another loan agreement on the table that is better for you than that. Also, watch out for any early repayment fees and penalties. If you're thinking that you're wanting a loan for 5 years because the repayments are lower, but actually you expect that you're going to be able to repay that after a year or two, just make sure that there's no early repayment fees, any repayment penalties that you're going to have to pay. And watch for that APR. Please do watch for that APR. Oh, and one final thing to watch for is upfront costs. Sometimes the interest rate might seem good, but there's a big setup fee included in it. Check those setup fees, check the agreements, and make sure that you understand exactly what it is that you're signing up to. Red flags. Businesses do not get loans typically if they have got big overdue tax bills. And the reason that they don't is because HMRC could call that in at any time and wind your business up. And because they've got form for doing that, the banks don't like it. So if you have got big overdue tax bills, then really you're going to need to get those paid off before you go in for any kind of loan product, because that would be a red flag to a loan provider. Equally, directors' loans. If you've got a big overdrawn director's loan account and you're taking money from that director's overdrawn loan account on a monthly basis, typically the bank's not going to like that. They don't want to provide a loan that funds your director's loan. They're looking to provide a loan that helps you to move your business forward. So do watch for big overdrawn director's loan accounts, because they also can be a red flag. Now, business viability was something that's always been around within the banking system, but it's really become in the forefront throughout COVID-19. And people have started to talk about this business viability more than they ever did before. Fundamentally, that's about whether or not you can pay your debts when they fall due. And also whether you've funded business losses with loans previously. And whether or not you've made a profit to date. So if you've never made a profit to this point, then that could also be a red flag to a bank who are going to decide that you are not a viable business. Because of COVID-19, typically they're looking at your viability prior to the pandemic. So that could make a difference to you. But just make sure that you are going to be considered a viable business to the bank. Now, they all have slightly different criteria on this, but fundamentally, those are the criteria that they're using. So that is the final session on raising finance and funding. I hope you found the session interesting and useful.